You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. My name is Peter Higgins and today I'm delighted to have Steve Clapham with me. He is the founder of Behind the Balance Sheet, and Steve has over 25 years investment analyst, researcher experience, and he's decided to put together his experience to good use to offer training and professional investment analysis for portfolio managers. And he's gone on to develop this under his Behind the Balance Sheet brand. He's also quite a famous author with an Amazon #1 bestseller. And that book I've got here, as you can see, is The Smart Money Method, How to Pick Stocks Like an Hedge Fund Pro. So we're going to talk a bit about Steve's book throughout this interview. Steve, welcome. How are you doing, sir?
Well, thank you very much for having me on. I'm really grateful to you. And just one thing I should say is that I don't just train professionals. So, you know, I've got two legs to my business. I train professional investors at some of the biggest and most successful funds in the world, really. But I also train private investors. So I've got an online school at behindthebalancesheet.com where you can sign up and do a course and improve your investment skills. So, I think it's very important to share this stuff, which is why I wrote the book, because, I wanted to help people. I think there's a lot of people who feel that the stock market is a bit of a scary place. They don't want to get involved. They don't know what, they don't know what's involved. They don't know how to start. They don't know. And then, it's really an important thing to take control of your finances. And why pay professional fund managers to manage your money?
I was going to get into all of that later on, Steve, but you're absolutely on point, and I completely agree with you that there's a growing force of the DIY investor, and to learn and to grow and to continue to learn is very, very important for all investors, including private investors. Now, I wanted to start, Steve, and go back a little bit and give people a little bit of an in-depth analysis of your journey, if I may. You trained as an accountant before joining the equity research department at Govet, one of London's top stockbrokers. Please, can you share with us your first experience of that role and how it initially developed you as a researcher of balance sheets of listed entities, please?
Well, Govet was a number 5 broker in London. And when I joined, I'm very old, in spite of my charming, young, good looks. Don't be deceived. I am very old. And my very first day, I arrived in the office and I was shown to my desk by the then head of research, Bob Cowell, who people might know his name because he was the Cowell in Makinson Cowell, which is the premier investor relations consultancy in London. And Bob showed me to his desk, and on my desk was a phone book, an internal phone book, a phone, and a key and lamp system. And your younger listeners and viewers won't know what key and lamp system is, but basically it allowed anybody in the box. So the box had 10 desks, and I was in the industrials box, so everybody covered industrials. Any of the analysts could pick up anybody else's phone, because the most important thing is that when a client rings is to pick the phone up. And I turned around to Bob and I said, Bob, is there any chance I could get a personal computer? And he looked at me and he said, a personal computer? What would you like? What sort of computer would you like? I said, could I have an IBM PC, please? He said, sure. And he got the phone book, he flicked down, he said, call this guy, tell him you want 4 IBM PCs and you're in charge of computer training. That was that was the first thing that I did. But I joined as the corporate finance analyst. So I used to do projects for the corporate finance department that the specialist analysts couldn't otherwise do. And so I used to spend a lot of time with Richard Westmacott, who was the chairman of Horgavet and one of the most respected stockbrokers in London. And that was quite fascinating because Richard is a very slightly strange character because he could not make small talk. I mean, if he was with Margaret Thatcher, as he often was, he could have a chat. Getting a lift with them, it was a nightmare. I mean, really, I don't know whether I was just at such a low level that it was difficult, but it was fascinating working with them. I remember being in his car, going to a meeting, and our clients at Horgavet included Hanson Trust, which was the most profitable client to have. They did loads of hostile takeovers. And I was in the car with them, and Lord Hanson called. And, it was all code words and code blue, but, I knew exactly what was going on. They were about to launch a takeover the next day. It was all very, it was very exciting, very, very, very interesting.
So from that early initial, going into I call it the frying pan almost, as a junior, and then being thrust into that sort of world. What was it that, as a researcher, that really nurtured you, that made you see, actually, this is quite deep stuff? Because people think of accountancy and they think of looking into balance sheet and they go, and the ordinary person look, but it's so important, Steve.
Well, I was doing very interesting projects which weren't necessarily related to the stock market. So I did a lot of privatization work. So I published a privatization note. I can't remember how many I did. I mean, it wasn't like a monthly or something, but, looking at the performance of privatizations. And I used to go in with Westmacott and, a team of corporate financiers to present to the government when they were privatizing a new industry or a new company, and then worked on the flotations. So the stuff I was doing wasn't actually heavily accounting focused because I was looking at new industries which had never before been in the stock market. So, for example, I was heavily involved in the privatization of BAA, and that was a fascinating time because there wasn't another airport in the world that was quoted. So, yeah, I mean, there was the usual sort of financial analysis skills required, but you also had to understand a completely new industry and then work out, well, there wasn't a comparable to compare it against, right? I mean, there wasn't another airport listed. An airport had never changed hands commercially. So we had no transaction multiples, we had nothing to base it on. So obviously, the stock market flotation price was what the brokers advising the government felt they could get it away at. We were advising the company, which was in many respects a more interesting job because it wasn't our job to try and get the best possible price for the government. Our job was to ensure that the investors understood not just the opportunities in investment, but also the risks. And this was a business that was incredibly capital intensive. Obvious, right? It owns Heathrow Airport and, a new runway, a new terminal. These things are massive, massive investments. But the opportunity once it was floated was to get, really good shareholder base, help the company communicate its message. And I did a huge amount of that because obviously it was a part of the civil service that didn't have an investor relations function. They had to go out and find somebody to do it. And so I helped, train the investor relations people. I helped them formulate the investment message, how they presented themselves to the stock market. And of course, 6 months after the flotation, we had the stock market crash, 1987 crash, which was very interesting because of course, this was a partly paid share. And until that time, the partly paid shares, which were floated in the stock market, were geared bets on a bull market. But when the stock market goes down, the gearing works in reverse. And I remember going to a meeting with the chairman of BAA, the chairman of Schroders, which was a merchant bank, and the head of corporate finance at Horgavet. I don't know why I was asked, I really didn't have anything to add. There was, 100 years of stock market experience in the room, plus me with like 2 years, but, or not even 2 years, a year. But it was amazing to me that I was able to sit at the table with these very important people, and there was one or two things that they might ask me about how the people I was speaking to viewed the business, and so I had an important role to play, and it was a very different from my previous roles. And in fact, I ended up in the city because I'd originally been planning to go and work for the fifth largest company in the UK, and I had a role that was two off the finance director. And they'd offered me the job, I'd accepted the job, and then they called me up and they said, "Oh, Steve, we made a mistake. You're actually too young to be this grade. And wow. Next year we'll promote you and you'll get a raise, but you'll have to come in at," and I can't remember what the numbers were, but like £1,000 a year less. And I said, "Well, hang on a second, I can either do the job or I can't." And they said, "Oh, of course you can do the job. You'll be doing exactly the same job. It's just a technicality." And I said, "You know what? I don't want to work for a company that, it promotes you according to how old you are. You can stick your job." And that's how I ended up in the city. Yeah.
Brilliant. I love that, Steve. Now, obviously, one of the major things that I think has happened is the development of the hedge funds over the past 20 odd years, and you've had the good fortune to work for some behemoths. So I wanted to talk about that, if I may, and jump forward a little bit. You're the former partner at an hedge fund, Steve, and investors have a lot of misconceptions and ideas about hedge funds and their behaviours. In layman's terms, please could you firstly give our listeners an overview of a typical hedge fund, and then an explanation of the hedge fund that you were a partner at, please, and your role.
I can't really talk about my former role because I've signed a 65-page agreement not to say anything. So
okay, let's talk about a typical hedge fund then, please, Steve. That's fine.
I don't want my former boss to sue me because he's very rich and could afford to spend quite a lot of money. I don't think he would, but I've signed an agreement which I don't want to renege on. I don't think there's really such a thing as a typical hedge fund. I mean, every fund that I've worked with, and I've got lots of hedge funds that are clients. I mean, one of my clients is one of the most successful hedge funds in the world, and in fact, I was there not that long ago training some of their new recruits. And every fund is very different because there are pod shops like Millennium and Ballyasney where they have, reams of individuals, and individuals are given money to manage on a very narrow band of risk, and their capital is allocated or withdrawn from them according to how well they perform. But, those are fairly universal, fairly standard. But aside from that, most hedge funds are very heavily influenced by their founder. So, almost every hedge fund, the guy that started it or the girl that started it is still there. And they are, the people that dictate how the fund is run, the culture of the firm. But I mean, I think there's a lot of misconceptions. The funds that I've worked for have tended to be very fundamental in nature. So they're actually on the long side of the book, and you're aware that there's a long side of the book and a short side of the book. And on the long side of the book, they're very similar to a good long only institution, looking for good fundamental ideas. Well, no secret, publicly available information. The first fund I worked for, I mean, we would own shares for 3 to 5 years, and the ones we owned used to go up quite a lot, but they were there, other than the performance of the stocks, because we did and we could afford to do much more work, much more intensive work, much deeper work, have a much better understanding of the business. And because we were a very large fund, we took very large positions. Were very close to the management of the business that we were invested in. But there is no difference from a traditional long only fund that would be a client of mine. Now today, the short side of the book, obviously, it's a very different type of endeavor. So although we would be quite concentrated on the long side, on the short side of the book, we would take smaller positions. Now, I think this is a fairly typical strategy. I mean, the last hedge fund I worked for, we had equal positions on both sides of the book because we were cuter on short-term timing. So, the principal was a former prop desk trader. So he didn't really make a distinction between the short and long. But for most equity long short hedge funds, the short positions will be smaller. And the reason the short positions are smaller is you generally do less work on them, because you're not planning on owning them for as long a period. So you need to have shorter positions, because if they go against you, when you are short of something and it goes up, your position increases. When you go into a stock and you're too early, it often happens. You can average down. You check, have I missed something? Obviously, you need to make sure that you haven't made a mistake. But if you're still confident you're on the right thing, then you can buy more of it. If you're short, to increase the short is a much, much more difficult. Just psychologically, it's much more difficult. And generally what happens is, if you're short something, it goes up, you'll reduce the position to reduce your risk. So you end up on the short side of the book having more positions, smaller positions, less work on each, and you're owning them for a shorter period because you're trading more. I mean, that's not to say you wouldn't take a short position in a fundamental stock or something you thought was a fraud and hold that for a long time, or a short position that you were doing a thematic short. So you might be short of exposure to a particular segment of the US economy, for example. So you might just say the US consumer, 70% of the US economy, they've got a whole load of debt and they're going to suffer in the next downturn. So you might be short of a big US consumer stock that you could have a massive short on because it's very liquid, and you might have that run that short for, today you might run it for 12 months in the expectation that, the US economy will dip. But generally speaking, the shorts were specific and quite trading oriented, if I can put it that way.
Now, Steve, you set up Behind the Balance Sheet in 2018 as a training business initially dedicated to helping professional investors, and you built it and then developed it further to help private investors. Can you give us an overview of the whole business, please?
Sure. Well, I mean, the business has got 3 legs to it. So the first leg is I do mainly a forensic accounting course, which I give to professional investors, a 1-day course. And I go through in great detail how to spot companies that are managing their earnings or presenting their earnings, inflating their earnings. I mean, it so happens we study some past frauds because obviously they're extreme cases of companies that are managing their earnings, but it's really about spotting, companies that are presenting themselves as high quality that aren't as high quality as they really are. And I do some bespoke training. I do some bespoke research. So, my next training course is for a client that a very big quants fund and I train their quantitative analysts in just how to understand the financial statements. And I've got an advanced valuation course. I've got various content. The second part of the business is the online training school, and we've got, I don't know, students in over 50 countries, something like that. And we have the most popular product is the Analyst Academy, which is basically everything you need to know to be a competent and confident investor. So it's got 5 modules. The first module teaches you how to look at the accounts, how to read the financial statements, how to spot companies that are cheating, how to understand the balance sheet, how to look at the cash flow statement. So it's much, much more intensive than just looking at the P&L. The second module is about finding a stock idea and researching it. You know, how do you find an idea? How do you find a good stock? How do you research? How do you check whether it's a good one? The third module is valuation. How do you value a business? And we go through all the different ways that you can value a business. The fourth module is putting all this together. So you've found the stock, you've checked the balance sheet's okay, you checked that it's profitable, you've checked the valuation is cheap. When do you buy it? So we look at technical analysis. A lot of fundamental analysts tend to overlook the importance of technical analysis and understanding, you know, you can make a lot more money if you get your entry and exit right. So, you know, it's not about, is this a good company, but when to buy it. And then how do you build your portfolio? How do you construct a portfolio so that you've got the correct amount of diversification to suit your personal requirements? And then we go into the macro, you know, what do you need to know? You now got a portfolio. How do you monitor it? How do you watch the macro? And I've got a whole bunch of professional economists who've contributed their views and what they think is important. And the fifth module is a whole bunch of case studies. And that course is very detailed, and you've got to want to learn, right? Because you can't, you know, you can't become a good investor without A, losing money, and B, understanding quite a lot. And what we've tried to do is to put everything in one package, and it's £149 a month for 12 months, because we thought people don't want to pay a big check up front. They may find that they don't like the course. So we offer a 30-day money-back guarantee in all our courses. So you can try it out, and if you test drive it, if you don't like it, we'll happily give you your money back. I mean, we don't, you know, no questions. I say no questions asked. I actually always ask, because if somebody, it doesn't happen very often, if somebody asks for the money back, there's obviously something wrong, and you know, we can learn from that. And usually people go, oh, I hadn't realized that it was quite difficult to invest in the stock market. And well, actually, it's not that difficult to invest in the stock market, but to invest and make money and to know what you're doing, you cannot do that without a bit of effort. But I've got people that are students. I've got people who are incredibly successful businessmen who've sold their businesses. I can't tell you how many people have sold their businesses, and they've then gone to a wealth manager and they said, I've got 10, 30, 50, 100 million pounds to invest. And the wealth manager has said, oh yeah, well, we'll put you in Terry Smith's fund and we'll charge you, 50 bips. And the guy said, well, hang on a second, I could do that myself. And I've got one client who actually emailed me very recently, and he's up this year. And he said he would never have had the confidence to pick these stocks and invest in these stocks if he hadn't done my course. It wasn't that, I mean, the guy has had a very large business, and, he's a very, very wealthy guy. He's a smart guy. But it was feeling comfortable was the battle. He didn't trust his own judgment. But by doing the course, he thought, well, actually, I can do this. And sometimes it's just having the confidence. And the third part of the business is a publishing business. So I've got a newsletter. which is published on Substack. So all these things are on my website, behindbalancesheet.com. I've got a podcast, so I do what you do, Pete. I'm on the 15th I only do it once a month because it's quite a lot of work, quite a lot of preparation. So I do it once a month. But then this last month, as we speak, the current episode is with Sir Clive Woodward, who took England to the world #1 at rugby, who's a really fascinating character. I mean, I saw him speak and I thought, God, why have I never thought of this? Because the connection between sport and business, there's a really, really strong connection. And he was so interesting, and doing the research on him was so fantastic, really, really enjoyable. And next month, I've got Carson Block, the world's #1 short seller, who I was very surprised. You know, I said to him, look, Carson, you've done 1 million podcasts. Let's not talk about how you got into short selling, because it's a really fascinating story, but you've covered it 100 times. And, you know, anybody that's listening to my podcast is bound to have heard of you and bound to. And he said, yeah, so we covered it just very, very briefly. And I said, so how'd you find these ideas? And I fully expect him to say, oh, well, Steve, you know, obviously I can't tell you my secrets. But, you know, he then started to say, so this is what I look for. And then I do this, and then I do that. And it's like a master class from the world's #1 short seller and how to spot a bad business, how to spot a bad company, how to spot bad management. So I found the podcast, I don't know what your experience has been, but I found it to be really fascinating, really enjoyable, because, you know, I would never have had the opportunity to sit down in my office upstairs in the studio, sit down with Sir Clive Woodward for 75 minutes or 90 minutes. And, you know, it was really good fun. And we've got the Substack, we've got a YouTube channel, and we've got various other initiatives sort of planned for the next 12, 18 months.
Brilliant. No, I'll be looking forward to those interviews. And Sir Clive Woodward, 2003, they won the championships, didn't they? I spoke with Steve Thompson regarding all of that as well. Fascinating guy. He's got a lot of praise for him. Now, Steve, you touched on going outside the comfort zone and confidence as well there. Psychology, Steve, plays a huge part in investing. And you point this out beautifully in the quotes in your I think it's either a recent interview or within your book. It's twice as painful to lose £1 than it is to gain £1. So when you start losing money, you get very stressed. The nature of the stock market is that the market can go up and down, so you will lose money from time to time. Please, can you expand on why this remains the case for even the most experienced fund managers and investors?
Well, I can tell you that I was with the one of my clients who started, you know, a huge enterprise, and I mean, I don't know what he's worth, but, you know, he just gave 50 million quid to one charity, you know, and that's not the only charitable donation. He you know, he's an incredibly successful guy, and he still runs money. So he's got a huge organization, but he still runs money. He only runs one fund, and he doesn't, you know, he's got other people running other funds, and he doesn't, you know, some hedge fund managers, there's one fund and they run it, and, you know, you might have a share of the book, but at the end of the day, it's his decision, the boss's decision. But this guy runs a fund, one of many funds in this organization. And he said to me, he said, well, I only get 55% of things right. And, wow. You know, I mean, he's probably a billionaire, right?
Yeah, amazing.
And you think, okay, so, I mean, he's also very humble. And the most successful managers, particularly hedge fund managers, most successful of them are usually very humble. But the simple fact is that things change, that you know, if you're trying to make exceptional returns, then you're going to be taking on a bit of risk, and you'll get things wrong. So things can go wrong in various ways. Things can go wrong because you made a mistake, right? Because you thought something was going to happen and it doesn't. So you think this business is going to get taken over and it doesn't, or you think this manager is going to buy back shares or improve margins and he doesn't. So that happens a lot. Things can go wrong because the time scale doesn't work. So you found the right stock, and in 3 years' time it does go up, but you can't wait 3 years. And the one thing I think as an analyst you can get the fundamentals spot on, but you can't necessarily dictate when the stock market will recognize what you've recognized. So by definition, usually you're buying something that other people don't like or dislike for a particular reason. And just that, where's the catalyst? Might not happen. And then you can get things go wrong because of an exogenous shock. You didn't expect Putin to invade Ukraine because all logic said that he would be mad to do that. And you thought Putin's the richest man in the world. He isn't stupid. And you underestimated, his desire to keep his own people at bay and repressed, and the need for him to stay in power, because otherwise, if he doesn't stay in power, he's a dead man. And he was highly, highly motivated to invade. But you kind of got that calculation wrong, and you were short of oil or long of BASF or whatever, all sorts of things that you can get wrong from an exogenous shock. So, and then, the stock market can just be completely irrational. Summer of 2021. I mean, these things, the stock market is a very funny animal. And I remember having discussions about Zoom in the middle of COVID. And Zoom, I think it got to 170 billion. Am I right in saying that? Or was it 70 billion?
Later on.
I've forgotten. Anyway, it was just like a stupid number. And, I was saying, well, this is really stupid number. But loads of people telling me I didn't know what I was talking about, And I mean, what Adyen? I did a podcast with Pete Davis of Lansdowne Partners and Spencer Crawley of First Minute Capital. And I'd been doing a valuation course for a very well-known multi-trillion-dollar fund. And they'd asked me to look at Adyen, which is, I think it's Dutch payments company. And it was capitalized at $100 billion. And it had 1.3 billion euros of sales. And I had a conversation as I was going into the Lansdowne offices with a friend of mine, Mark Rubenstein, who writes a newsletter, Net Interest, and is a real expert on all things financial. And I said to him, this is insane. And Spencer, who was just arriving, said, well, I was just talking to some of the guys in venture capital, and Stripe are looking to come to the stock market next February at $250 billion. And, and you think, well, I mean, Stripe's a very good business. I've got no idea what the financials are at that point. I had no idea what the financials were. So, 250 billion, it wasn't something that calibrated. It sounded like a big number. And, Adyen, $100 billion, I remember it. So the client asked me to do a valuation of Adyen for the course. And I said, well, look, if you'd asked me when Adyen was $50 billion, I'd have said this is daft. $100 billion, it's twice as daft. But, there's once you get a certain level of daftness, you can't double it, And I just said, so let's just see what this company would have to do in order for you to make money. And I think if I remember correctly, I said it have to grow its revenues at 40% compound for 15 years, maintain its 56% EBITDA margin, And in 2035, it would be fair value. So you wouldn't make any money unless it did better than a 40% compound growth rate for 15 years and flat margin. I don't know if there is a company that's grown at 15% compound for 40 years. Listeners should be aware that, compound interest is, 40% for 15 years is a big number.
Indeed it is. Now, your brilliant book, Steve. I want to focus on that now, if I may. You said something really beautiful in your book, and just shows the level of humility given your vast experience. You stated in your book, the Smarter Money Method isn't really about anything other than your investing philosophy. Therefore, please would you be kind enough to share with our listeners the framework process that you've developed over the decades as an investment analyst, starting from the moment you've identified an idea to auditing it, checking the balance sheet to when you go, okay, I'm going to buy that. Just a quick synopsis of that, if you may, please.
Well, how long have you got? I mean, the book's 200 and
Well, we've got 45
pages.
minutes, mate. We've done 20 minutes as it is now.
I so the book, The Smart Money Method. I've always wanted to write a book, and I used to keep a notebook, and if I got a good idea from a competitor as to how they did something, I used to write it down in this notebook. And eventually, the notebook got full, and then the notebook was actually the genesis of the book. Because when I was thinking about, well, what should I write about, and I had all these notes, and I thought, oh, what I should do is I should formalize how I do this. But I'd never written it down before. The notebook was the closest thing I had to anything about my process. And that was only just so that I could remember things that I'd learned from other people that I could copy. And, because you go to a conference and you're talking to one of your competitors, one of your pals that works for a rival fund, and you're talking about, the last thing you got wrong or whatever. And he says, oh, I would have spotted that because I do this. So, oh, that's clever. I'll use that next time. And so I just thought, well, let's write a book about, how people can invest. Because as I said at the beginning, Pete, the thing is that, people are scared of taking control of their own future. And honestly, we're sitting in 2022. We've seen, a bit of a bear market since the summer of last year. But we're in, what look like incredibly difficult times. And the one thing that you can be 100% sure of is that what has worked in the last 40 years ain't going to work in the next 20 years. So we had 40 years of falling rates, and Albert Edwards, the famous SocGen strategist who came up with the Ice Age, and all you needed to do was buy bonds. Even Albert Edwards has thrown in the towel. I listened to him yesterday. He said it's the end of the Ice Age. So you can't do 60-40 equity bonds. You can't give your money to a wealth manager. You can't give your money to even, brilliant investors like Terry Smith. I've got the greatest admiration for Terry. He's done incredibly well, but the stocks that he owns have gone up a huge amount. And it's highly unlikely that he'll be able to do as well in the next 10 years as he's done in the last 10 years. And I think that the next 10 years is going to be very different. So I think in order to make money, or not even to make money, but in order to preserve your wealth, preserve your capital, you need to do something very differently in the next 10 years. I think you need to be much more active in holding equities and turning them over. So you need to be much more nimble. That's my personal view. And so the idea of the book is to enable you to do that. And so, I give you tips for where do you find stock ideas? And you can find stock ideas everywhere. You can go to the supermarket and say, oh, that's a fantastic product. And you can go and work out where it came from. I did a competition on my newsletter, and I gave everybody a mini course that was like a 3-day. We called it the 3-day stock idea challenge. And what the first challenge was, what product have you bought that you would like to invest in? And we got some great. I mean, there was one lady. It was amazing. I mean, she did three emails to me, absolutely brilliant, which I wrote up in the newsletter a few weeks ago. So, find the idea, and then once you find the idea, you go, is it a good idea? And then you've got to do a bit of research into the financials. So I don't explain in huge amount of detail. One person gave the book 1 star on Amazon because they said it was all about me selling courses. And I was like, what are you talking about? But, I don't go into the detail that I go into in the courses in the book about how to check the financial statements because, it would be a whole book on its own. But I give, a bit of color on that. And there's lots of places you can learn that. I explain, how do you check whether, this is a company that's making good returns on capital and is cash generative? And then how do you check that the management are honest and are sensible allocators of capital? And how do you check the company's got a future? So I go through all of that. I'd say a little bit about valuation. I don't go into a huge amount of detail on valuation. I didn't want to write a 1,000-page book. A 280-page book was too.
Well, the beauty of what you did do, Steve, is that you focused on your 3-pronged checklist, which is essentially margins, conversion of earnings to cash, operating profit into cash flow, and working capital ratios. So do you want to just share with our listeners the aspects of that and why those 3 are that important?
Well, I mean, these are the 3 things that I say if you're going to, if you want to avoid frauds, these are the 3 things you need to look at. The first is margins, because you've got to understand, how does the company make money? And, frauds often have margins which are much higher than their peer group. And you've got to ask yourself, well, if it's got very high margins, why is that? And if it's got low margins, why is that? And could that change? Because, people often don't realize that a company with low margins may have low margins, but it's been badly managed, or because input costs have happened to be high and will change. The conversion of earnings into cash flow. I mean, funnily enough, I'm talking about this in my Substack this week. Is fundamental. How much of your earnings turn into cash? Because if your earnings don't turn into cash, you might not be, the earnings might not be honest, and B, they won't be as lucrative to you as a shareholder unless they're cash earnings. And the working capital ratios, I think people just, they sort of look at a return number and they don't really sort of think through what does that represent. Businesses need a certain amount of fixed assets. Even if you're Amazon or Google, you need a certain amount of fixed assets. And you need a certain amount of working capital. And, how much working capital in the form of customer receivables, inventory, financed by supplier payables, how much of that do you need for an incremental dollar or pound of sales? And that dictates how much cash you're going to generate from any growth. And so those three parameters, I think, are very critical to understanding a business and understanding whether it's going to make money for you.
Brilliant. I love that response. Thank you. You also touched on something that's quite important. You phrased it differently to most people I've read in the past. You've called it the collection cycle, Steve. Can you expand on that and why that's so important for a company?
Well, the collection cycle, I mean, I think it's I thought it was a generally used term, but the collection cycle is simply you make widgets. So you buy steel and you make it into a finished product. So you've got a supplier for the steel. How long does it take you to pay them? How much steel, how many widgets do you have in inventory at any point? And how long do your customers take to pay you? And that adds up to a number. And so, how many days of inventory you have, less how long it takes you to pay your suppliers, and how long your customers take to pay you is a total number. And if that total number is very small, so if you look at Facebook or Meta, that number is zero, right? So they don't have any capital tied up in working capital. I say it's zero. I don't know I haven't looked at it for a couple of years, but last time I looked, it was zero. If you look at a company that Electrolux that make white goods, they've got, I've forgotten the exact numbers, but they've got something like 60 days of inventory, and it takes customers 50 days to pay them. So, they've got 110 days. They take 110 days to pay their suppliers. So they've also got a working capital of zero, a collection cycle of zero, same as Facebook or Meta, but in a much less robust environment. Because guess what? If it's taking you 110 days to pay your suppliers, they're not going to be supplying you for very well. If you take any longer than that, they're not going to be supplying you, and they're probably charging quite a lot for that privilege. So, my guess would be, and again, I looked at Electrolux last time, I think in 2018. So that, don't go looking up the numbers for December 21, which I haven't looked at them. I don't know what they're like, but it's just an illustration. I would have said that, they'll find it very difficult to improve their collection cycle, and therefore, their return in capital, how is that going to improve? If it's going to improve, they either need to figure out how to use less fixed assets, have less money tied up in the production line, in the factory, in the machinery, or they're going to have to improve their margins. And in a cutthroat business like appliances, where there's competition from the Chinese, from the Koreans, from the Americans, they're going to, it's quite a competitive business. So you've got to ask yourself, well, how's the Electrolux going to improve its business? It's going to be quite difficult. So
I get that. It's quite important. Now we'll just go seamlessly to the difficulties which you've spotted in the past, and some people didn't spot. Please can you share with us some of the red flags that institutions, fund managers, and private investors clearly missed with regards to the likes of Conveniality, Patisserie Valerie, Carillion, and other recent stocks that have imploded?
Well, Carillion, the working capital cycle, the collection cycle, would have told you all you needed to know, because the collection cycle was very negative, which meant that Carillion, when it completed a project, had to get another project to fill the gap, because it's a typical construction business, very low margin. The way it makes money is it gets its cash from its customers before it pays its suppliers. So it's constantly got to fill its backlog, otherwise it'll run out of cash. And there was one year where its collection cycle went from being, I've forgotten what the number was, 30 or 40 or 50 days negative to zero. So, that cash just evaporated. And that was, that was quite a good warning of what was going to happen at Carillion. But Carillion was obviously, 2 years before it went bust, I did an interview on Radio 4 where they did a whole segment. I never listened to it when it went out, but it was 10, 15 minutes about why Carillion was I don't think we said it was fraudulent, but we said it was an unsustainable business. Conviviality was a tax thing. don't really remember too much about. I didn't really look at it. But Patisserie Valerie was one that I thought was a very good illustration of all sorts of things that you could easily have spotted as a private investor. And it's rather embarrassing because I was asked to speak at Mello on a panel about Patisserie Valerie after it had, you remember they injected, they had a rights issue, injected some capital when they couldn't pay the VAT man. And I did, I did a few slides and I said, who in the room holds Patisserie Valerie? And I had no idea who held it. And about 1 in 3 people, oh no, not 1 in 3, 1 in 10 people, there was about 300 people in the room and 35, 40 people put their hands up. And I then proceeded to tell them how stupid they were, which was, was probably not as diplomatic a thing as I could have done. But, I just said, look, it was reporting 15% margins. Cafe Nero, so I reported 15% margins, which had actually gone up slightly over the previous 5 years. Cafe Nero, which was a very, very similar business, had reported margins of under 10% 5 years previously. And its margins had halved in the past 5 years for very simple reasons, including the exit from, or the vote to leave the European Union, the Brexit vote, meant that sterling collapsed. And guess what? Coffee is imported, right? Most of our food is imported. Most of the stuff they were selling was imported. So, unless they'd managed to put their prices up, which wasn't evident in the revenue growth, in fact, their sales the sales per restaurant had not moved. It actually had declined slightly over the previous 5 years at Patisserie Valerie. I said, look, it was reporting 15% margins. Costa was reporting margins which were underlying 6 points, 5 or 6 points lower. Costa, similar business. Starbucks was reporting the same margins. You ask yourself, who do you think's more efficient? Patisserie Valerie, who mainly selling cups of tea and cake to people sitting down in a restaurant, or Starbucks selling coffee globally, half of it to take away? I don't know, maybe more than that, maybe 70% to take away. As soon as you've got a table, you've got floor space, you've got rent, you've got waiters, waitresses. What's the single biggest cost in a restaurant? 36, 38% of revenue is labor. Rents, 10%, 11% of revenue. It's inconceivable that a business that was not selling product to take away, similar product, right? I mean, coffee is one of the highest gross margin products that you can get, coffee and tea. Coffee is actually even more expensive than tea, but very, very high, very, very high gross margin product. I mean, depending on what you include in the definition of cost of goods sold, if it's just the coffee, it's 90%. If you include the direct costs of production, it's probably 72, 73%. And Starbucks, selling coffee to take away, I mean, obviously is going to be, much, much, much more profitable. I think
Now, Steve, I'm conscious of the time. We're going to run out of time, so I'm going to just fast forward and ask you one final question. And I'm conscious that we've run out of time. I do apologise. Now, Steve, you share with us your strategy regarding how to find good companies. I'd like to ask you regarding your own investing strategy and a little aspect about its diversification for our listeners, please.
So my investing strategy is I own equities. I very, very rarely own bonds. I bought Glencore bonds when people thought Glencore was going to go bust, and they had a bond maturing in 12 months' time that was covered easily. And I made 40% or something stupid on it like that. But generally, I own equities. That's what I know. And I don't believe bonds will be a good investment for the next 10 years. And I'm a global investor, so I don't own very many UK stocks. I tend to own stocks overseas. I've got a big position, and I've had a big position for the last 15 years in India. And I believe India is a massive opportunity, but I can't buy individual Indian equities because I don't have. I'm not Indian domicile, but India is my biggest position through funds and ETFs.
Brilliant. Now, Steve, what I'm going to try and do is at some point or other, I'm going to try and come back to interview you again, because I've got through about half of my questions here. So I do apologise for rushing the ending at the conclusion of this. And hopefully we'll come back. So that was Steve Clapham, behind the balance sheet, business consultancy, platform for informing and educating institutional investors and private investors alike. You can find Steve across numerous platforms. Please visit his website. You can find him also on Twitter. Steve, it's been an absolute pleasure speaking to you, and I hope we can get you back to conclude this interview at another stage. Thank you ever so much for your time.
Thank you. Good to be on. Thanks.